Good evening and welcome to the earnings review, your tidbits into company financials and operational insights. Thank you for joining us as we broadcast from Hampton Studios in Harare, Zimbabwe. I'm Ibn Mabunda, yo money man. On the show, we engage top echelon executives to get you up to speed with first-hand information. We also make it a point to ensure that we've got competent market analysts just to ensure you're furnished with relevant and comprehensive market analysis. Tonight, we focus on the People's Own Savings Bank, one of the banks operational here in Zimbabwe. Now, the bank is owned 100% by the government of Zimbabwe and has 32 branches spread across the country with 200 agency outlets that operate through Zimpost. The bank was established in 1999 through an act known as the People's Own Savings Bank Act. Now, on the cards is a partial privatization deal that has been tabled by the major shareholder, that is the government, or rather the sole shareholder in that particular regard, the half-year 2021 results, and of course a recently held annual general meeting. But before we get into the nitty-gritties of this particular development, I have a guest, of course, the usual, Respect Gwenza, who's the chief analyst for Equity Access. Respect, good evening and thank you for joining us on the earnings review.
Good evening to you, Eben, and thanks for having me, like always.
Fantastic. Now, Respect, we've got quite a mixed bag. Tonight, we are discussing their 2020 results. We're also discussing their half-year 2021 results within that same bracket. And of course, the mouth-watering development of the possible privatization of this very entity. And several things to crunch right in there. And perhaps to get us kick-started, we'll just have a quick look at some of the teensy-weенsies from their particular annual general meeting, where the chief executive did spell out some of the key operational issues with regards to the future of the entity. Let's have a look.
And during that year, 2020, we continued with our business model, which is obviously like a three-tiered system where we work with the post office on one end and some agencies and provincial district offices on one hand. And on the other, we literally working with POSB's own 32 branches in major cities with an agent, and POSB continued being an agent of various money transfer agencies over that period. And in terms of governance issues, we find that we were governed by the Banking Act on one end, and being a state-owned entity, we also had to actually deal with the issue of complying with the PECOGO, the act that governs all state entities within the country. And as part of the restructuring program during the year, I think government had conceived the issue of privatizing the state entity from 2019. But due to from 2018, that's when cabinet approval was given. But the whole of 2019, challenges were being faced in terms of onboarding the consultant because of foreign currency restraints. But however, in 2020, we then brought the entity, the consultants on board. But however, the whole thrust now by government was partial privatization. Obviously, the desire is to see these development finance institutions bring in quality and equity and good capital within the banking sector. So amongst development finance institutions, POSB was also identified as one that needed to be partially privatized. And in terms of the financial performance of the bank, as you're looking at your screens there, you'd find that at the end of 2020 financial year, profitability was at 352 million. And carrying on into the first quarter, second quarter of the year, we actually carried on the profitability path. And there we do show you how we're comparing with the industry in terms of profitability, where the industry average was hovering about 1.8 billion. But we were there, obviously, because of our size. You then understand where our levels were, but we maintained profitability. In terms of capital adequacy, which is literally the capital in relation to our risk-weighted assets, you'd find at the end of the year we're at 53.6%, and in the first quarter we maintained that level a positive level of 41%, and quarter two, we had 46%. Compared to industry, we were actually performing above the industry average of 34.62%. And then in terms of capital adequacy, both tier one and tier two, it now breaks down to show that our capital at the end of 2020 was 993 million. But as the first quarter of 2021, the year we are in, it rose to 1.1 billion. And now in the just ended half year, it has risen to 1.3 billion. And compared to the industry, you'd find that the industry average is about 2.1 billion. And then in terms of asset quality, you find the non-performing assets, we were performing better than the industry at a ratio below the unitary level of 1, at 0.9, 0.79, and then 0.81. And the industry was above the 1 percentage point at 1.75%. Liquidity, we were performing pretty well. I should say the whole industry was well above, it was quite not very liquid, but was just liquid. And you find we're just within the ranges of the industry as at the end of the year and as we went in. Coming to a very important other factors, if you're coming to trends in ratio analysis over the years, 2018 to 20, you'd find, for example, the blue line, the capital adequacy was up, as you notice, right from 2019, we started seeing a downward trend down to 2020 where we are. And if you look at the return on equity as well, on there you find the return on assets was on an upward trajectory. That's the yellow, that's the orangish line that you're seeing on the diagram there. And then you find in terms of non-performing loans, we've consistently, even during the COVID period, tried to manage our profitability to levels that are manageable and within the acceptable levels within the central bank. Going to another area, which is non-financial performance in terms of trends in actual number of account holders. I must say here to the shareholder that we used to actually have accounts that were way above the 3 million mark way back. But now we were suffering this because our market has been, we have had people actually cannibalizing our market in the process. Because of digital channels, we're finding that it's very easy to penetrate that market. But we are also on that trend. And you'd find that as we ended the year, we actually had quarter four of 2020, we were hovering around 926,000 against our target of a 1 million mark. But as we went into quarter one and quarter two, we are finding the trend is more or less still going up, 968. But unfortunately, because of other challenges, you're finding there was still an upward trend, but still not achieving our targets that we desired to. Coming to another very important factor, which is where we know that the belief amongst most people has been that POSB is the bank of the old, old people's bank. Instead of the people's own savings bank, people call it the old people's bank. But it's not anymore, as you can tell from the age composition of you would find actually from the ages of 31 to 40, we are onboarding such customers. And over the years, you'd find actually 26% has come up from that age cohort. And then from the 41 to 50, another 17%. And then above 60 years, you're finding that 13.31%. And you find 61 and above, which is basically pensioners, it's still a bigger portion of 30.26%. But I must say then, setting off from about 31 to 40 years, that sector would comprise about over 70% of our customer base. Coming to the gender composition, which is very key, as government is very worried in terms of gender representation, not only at board level, but also at managerial level, and also in terms of the customer base. We are saying the males comprise slightly more than the females within our population and within our customer base, with 52 or 53% males and 47% being females. But the strategies we are employing within the gender equality matrix is we actually have a window and deliberate associations with the Ministry of Women's Affairs and all that. We have a fund that we run on behalf of them. And also some of the COVID funds that we received from the government, we are deliberately channeling them to women-headed businesses. Going on to the POSB's market share, this will obviously show you that, as I said, we used to be quite big then, but now when we looking at ourselves, we're just at about 6.3% of the market in terms of number of customers. The value of deposits, we're at a 0.83, and then the loan values 0.95, and the net capital base 1.47, and then the value of profit at 0.53, and the total asset base, which is still in the billions though, at 3. We've got the banking sector being high up there, but we are at 2.9 billion as at the end of December. Now, another aspect in terms of technology, we have just signed on a partner who is here with us in terms of the omni-channel, and we are expecting that we are actually going to be the ground certainly from now on going forward.
Equity Live presents the complete online interactive presentation solution. Hosting AGMs, media and analyst briefings has never been this simple, efficient and affordable. Communicate globally through a combination of high-definition video and your prepared multimedia presentation from any location of your choice. Interact with your invited participants from all over the world in question and answer sessions and voting sessions in real time on our safe, secure and affordable platform. Contact Equity Live for a free customized demonstration. Equity Live, real-time presentation solutions.
That was the Chief Executive, Mr. Kandlela. They're giving us a breakdown of the 2020 results or performance in that particular regard. Just respect to, first of all, delve into their 2020 performance and perhaps to sort of decrypt what it is that informed their performance. They had a loss position in inflation-adjusted terms. In historical terms, it was a profit. However, in inflation-adjusted terms, the profit, they came through at 435 million Zimbabwean dollars against a loss position of $600 million in 2019, and of course that would be in restated terms. What can you tell us with regards to their performance given the macroeconomic backdrop that they had to face?
Yeah, so if you look at the 2020 results, I think there are quite some number of things that one has to put into context. But to just give a clear overview in terms of the economic performance of the country in that respective year, because this is the only jurisdiction in which they operate. So we found ourselves with another GDP decline, a growth rate which was in the negative around 10%. That's our own projection that Zimbabwe's GDP fell by about 10% thereabout. We also had hyperinflation picking up at about 8.30% in August of last year. We also had a currency depreciation upwards of 79% thereabout. So I think all these are clear macroeconomic indicators which point towards a deceleration in terms of the economy. And these are clear headwinds to what one business operating in this environment should incur. So when you have an adverse inflation outturn, it also impacts interest income. Why? Because the net is as a result of once you take out the inflationary growth, you then put it on the interest rate to see whether you made money or you didn't. So if inflation is growing at a higher rate than your interest rate, it means that you have got negative net returns on interest income. So this would be a negative. If you are also in an inflationary environment, the rate at which you grow your loans is also slow. Why? Because you fear that when you extend more, people may default on those loans, and you try to seek other ways of hedging value. You end up putting your money in non-monetary assets, be it property and so forth, which may not necessarily give you real interest in the short term, but it's a way of hedging assets. So these are a myriad of challenges that one company operating in this environment faced in the 2020 situation. Then we also have got the novel coronavirus, which hit the globe late 2019 into 2020, and this had also adverse effects, especially on transactional income. Why we saw a slowdown in transaction across the market, and given an inhibiting environment where transactional fees are at the mess of the RBZ, you would expect a slower adjustment in that respect. So I think 2020 was really a challenging or a turbulent year, but one thing that we saw here is a positive net outturn compared to the prior year, which is the 2019 financial year. But without digressing much into the various income lines, I think one thing to note is that when you look at what's called the relative, say, fair value gains that a company earned in 2020 and in 2019, you would find that there might be a disparity. There was a higher fair value income gains, which is gains that are coming from inflationary effects and also exchange rate effects. They were quite higher in the 2020 financial year. And when you also look at 2020, this is a year where also in April, May, thereabout, RBZ adjusted interest rates. So that meant that you have got higher interest rates and banks could earn more money from that. We also saw a rapid expansion of digitization across the market, most banks shifting their core banking systems to the latest in town. And what that means is that a whole lot of people are captured within that market, and there's a speeding up of transactions, and that would also mean an increase in terms of fee and commission income. So that's kind of the outlook and some of the drivers that could have sufficed to drive this performance.
Bog standard there, and of course that would spell their 2020 performance. Now, just to sort of quickly jump onto the 2021 performance, you have a profit position of 60.8 million Zimbabwean dollars over the 6-month period to June 30, vis-a-vis $138 million losses that were reported over the equivalent period of 2020. What can you tell us with regards to this very performance?
Yes, so I think these 2021 results are really up there when you look at the banking sector overall and what has been submitted by the RBZ as the half-year performance. The growth is in line with the broader banking sector. But I think more specifically, we should zoom in on the specific numbers there.
Right.
Find interest income.
Right in there, the net interest income growing 100% in inflation-adjusted terms, yes, to over 220 million Zimbabwean dollars.
Yeah, so that's quite an aggressive growth. I think when you look at the overall banking sector, it's actually ranking in as one of the highest growth in terms of interest income earned, but obviously that would reflect the growth in terms of loans and advances, especially to customers. If you look at their income from investment securities, it wasn't as much. So I think that growth really reflects the bank's aggression or trying to close the gap historically, where they used to have a low loan to deposit ratio. So whenever you are loaning out more, it means you are sweating more of your liabilities. So you've got a deposit that is possibly growing, and yet you are not extending that as credit. But then there are hazards, which I think we have highlighted in our chat before, to just say whenever the environment is not friendly, you slow down in terms of loaning out funds. Why? Because there's a serious default risk. There's a serious loss of value as well, which is coming out from the monetary losses that are rising out of inflation and exchange rate depreciation. So I think now we are seeing banks slowly beginning to increase their exposure in terms of loans, and for POSB there was that growth. But when you do a further analysis of the data, you would equally see that much of the growth really, or much of the those interest income is highly concentrated in loans to individuals. So that's also not a good reflection, because loans to individuals are typically for consumption purposes. But then when you loan out to the productive sector, you are pushing more of your monies in assets that really have got the ability to keep on generating income. So I think that exposure, when you look at that income line, is 2 over 3 attributable to loans to individuals. So I think as they go forward, they have to skew and try to rebalance their loan book and also push more of their resources to the productive sector. When you look at fee and commission income, another huge growth there that you see, it's almost 100%, so to say, and that's almost $700 and something million in terms of that income line. That's an equivalent of what banks, other bigger banks such as Nedbank, made in the period. So that really shows you that the bank has been doing more. Why? Because we are in an environment where people are no longer visiting the bank as often, and yet one bank is able to grow its fee and commission income, with that magnitude. It shows you that the bank has equally been pushing in terms of digitization. Yes, there used to be a tag which used to say this is a bank of the old, this is a bank for those that are not as tech savvy, but this growth in terms of fee and commission income clearly reflects that there has been a shift in terms of approach. There has been a clear investment in terms of scaling up the digital presence and competitiveness in the current landscape. I think when you then look at other income lines, their contribution was quite fair compared to the prior year, but these two were quite outstanding in terms of driving their operating performance.
Now, to sort of get into some of the indicators that are of relevance there, the bank has an NPL ratio of 0.81% from about 0.95% over the comparative period of last year, as well as a liquidity ratio of 57%. What do these indicators tell of the bank?
So when you look at the average banking sector, it's now operating below 5% in terms of NPL. This is from a high of almost 18% about 5 or 6 years ago. So there's been that movement, and then there's been that downward trajectory in terms of NPLs. NPLs are a reflection of non-performing loans. So whenever you have got a higher NPL ratio, it shows that much of your book is not being it's not generating the income that it should, or the loans that you paid have been defaulted on. So that was the case for most of the banking sector in periods around 2014, 2013, thereabout. The economy had stagnated, there wasn't any growth, and therefore it became difficult for customers to pay back their loans. So I think this trajectory has been inspired by a number of factors. You've got Zamco, which came into play around 2014, 15, thereabout, to buy these bad assets and to restructure them and so forth, so as to clean banks' books. And over the years, banks have also become more savvy. They were not just lending to customers that do not have clear profiles. So that has resulted in a downward trajectory in terms of non-performing loans. But I think in such an environment, when you see a figure of 0.0 something, it actually means a bank should now begin to lend more, especially to the productive sector. So I think it gives room for the bank to at least increase their exposure, because when you take that risk, you actually, when you increase your loan book, you are taking risk, and if part of it is not paid back, at least it slightly pushes your NPL up, but within the range that's acceptable. RBZ's benchmark is 5%. So I think any NPL which is about 3% is still quite favorable. So I think they should slowly increase their exposure in terms of loans, so that they get their NPL to a fairly higher level. When you then look at the other aggregate that you mentioned, I think it equally shows a liquidity ratio of 57% is still within closer to the threshold that's been set by the central bank. I think it's about 30% thereabout. This is just about looking at the assets that the bank has and its ability to fulfill part of its obligations to say, are you able to continue as a going concern? Are you also able to service your liabilities as and when they fall due? And so I think when you see a percentage of 57%, it's quite fair. But I think all that has to be discounted for the inflationary environment, for the exchange rate losses and so forth. So I think I think a ratio of 57% in such an environment is still conservative in my own view. I think it should be in the range of 85 and so forth, because you have to discount for the environment and it would still bring it back down there. So it shows that maybe this bank needs to do more in terms of scaling up its liquidity position.
To sort of zero out to get to a macroeconomic perspective, the most recent update from the MPC, the Monetary Policy Committee, has held the policy rate at 40% and the medium-term accommodation rate there at about 30%. What would be the impact where the sector is concerned, and eventually what would it cascade to in as far as POSB is concerned?
Thanks. So when the bank or the MPC decides in terms of the monetary direction of the country, they are trying to solve two key things: basically inflation, exchange rate, the current exchange rate. So whenever you lax your benchmark rate, you are promoting borrowing. Whenever you increase it, you are discouraging borrowing. In other words, you are tightening the monetary sector, and therefore people have less to expend immediately. So whenever the velocity of money or the rate at which money is spent is high, it actually results in increased liquidity in the economy. And whenever that liquidity is high, it might push prices up. Why? Because you have a higher growth in liquidity and a slower growth in production. So whenever there's that mismatch, it might cause a run. That's why you see prices going up and so forth and so forth. So when the bank is setting out a rate, it's trying to solve these key macroeconomic aggregates. And so Zimbabwe is presently maintaining it maintained a rate of 40% according to the latest MPC. What that means is that you have a relatively higher benchmark rate. So whenever banks come in to then price their own money, which they extend to clients, they are guided by that benchmark rate. So when your benchmark rate is 40, maybe you're also loaning out your funds at about 45, 50, thereabout, depending on other dynamics. So such higher rates are always relative to other things, like where is our inflation level. So when you have an inflation rate of 56% per annum, it's closer to 40% in terms of the benchmark rate, but it still is higher than the benchmark rate. So you have a scenario where you possibly review whether you should lend or not lend based on the differential of the inflation rate and the benchmark rate. So I think maintaining such a rate means further discouragement of borrowers to take out money from the bank. It also means a slower or lower loan to deposit ratios as we go forward. So what I envisage as we go forward is a scenario where possibly as inflation comes off, the bank also lowers its benchmark rate. But for that scenario to play out, it means that basic money creation through M0, which is RBZ's discretion in pushing out money to the market, it has to come off significantly. And so that scenario is quite unlikely as we head towards 2022 and 2023. So we are likely to continue to see higher benchmark rates. And I think as we move forward to the last quarter of the year, inflation is likely to now go up on a month-on-month basis above the 5% level. So I don't see the benchmark rate coming off. And what that means for the banking sector is continual instability within the interest income line.
I realize. Quite comprehensive, I must say, they respect. Now, lastly, let's talk about the much touted privatization of the bank, or should I say partial privatization with the possibility of a listing on the Zimbabwe Stock Exchange. Can you speak with regards to the implications of that very initiative and the value that perhaps could be created in the process?
For a bank like POSB, they have done quite well when you compare them with other state-owned enterprises over the past years. Yes, we have a loss position restated for 2020 and 2019, but generally they've fared well. At some point they would even declare dividend to government. And so I think what's needed is, as we go forward, yes, there's a room for privatization, partial privatization. Why? Because government controls maybe a higher stake in it. So maybe it's going to be gradual, but I think as the bank moves forward, government is willing to let go of a serious degree of control for the firm. But what that means to me is that whenever you privatize, you raise capital. So that's the biggest advantage there that you get, that the bank is capitalized. There is room to talk of expansion, or there is room to talk of bettering the product or bettering the quality of the product where cash flows are concerned. The other thing there, I think whenever you privatize and you go public, there is now much more public scrutiny. Presently, government is the only shareholder, so the view that comes in is limited to what government feels is right or wrong. So when you have a broad-based approach to management of the company, whereas they're tapping into the shareholding structure and an expand shareholder base, you've got a more robust engagement at strategic level, or even at shareholder level when you hold your AGMs and so forth. And one more thing that I think should be a key focus is seeking a strategic partner. I think in as much as the bank can be privatized, the influence that retail investors can have in terms of pushing for a certain direction, it will be very minimal. And so I think it's important to have a technical partner, foreign partner. They snap up 12 to 15% of the company. They get board sittings. They bring in the technical know-how. They also bring or increase that robustness in terms of putting a strategic direction to the bank. So it gives more power to just a retail-backed shareholder plan. So that's my thinking. But it will unlock significant value. The bank has done well, but it can do far much better and reconfigure itself for a sustained growth. And I think as that happens, the rate at which digitization is coming in will even speed up.
Thank you, Respect, for the insights. Thank you for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and visit our informative website, www.equityaccess.net. From the Equity Access team and I, Duncan, until next time, ciao.